Hi, this Saturday we have two interesting webinars lined up for you. At 10 a.m. we have The Age of Asset Allocation, and at 12 p.m. we have From Miles Away to Kodishwari, exclusively for NRI women. The registration link are in the description. Do register and join the webinar.
Why do people not make money in mutual funds? Mutual funds clearly are the simplest way to invest for the retail investor. We have had crores of people investing in mutual funds in the last few years. They are all new entrants to the mutual fund industry. They have all been in mutual funds only for one market cycle. But in every market cycle, we have participants like this coming into mutual funds in large numbers. In every new cycle, the numbers are far in excess of what we have seen in the previous cycle. Clearly, the preference to invest through mutual funds is very, very high. But do people actually make money in large numbers, especially those who come in late in a market cycle? I'm going to share some of my observations which are based on what I have keenly studied in the Indian mutual fund industry. From 1993, I've been seeing the mutual fund space, how money gets gathered, how investors crowd into specific funds, and how, despite investors investing money in large numbers in those funds, performance almost always doesn't happen where the crowds gather. There is a pattern to this. Mostly, investors buy mutual funds based on immediate past performance. There's a very high degree of recency bias that prevails in mutual fund investing in India right now. I'll give you an example. In this calendar year, investors heavily preferred small cap funds over large cap funds. Now look at performance and look at what happens in the next year, and you will realize that investors probably should have done the opposite. Similarly, chasing themes when their best is behind happens all the time in mutual fund investing. We saw how investors invested last year very, very heavily in IT funds, tech fund-oriented sectoral schemes. So, almost always when the performance looks the best and when past performance looks most rosy, money goes in there. This is why most of these investors who come in late into a fund based on the past performance don't stay long enough nor succeed in their investing. It doesn't mean that mutual funds are bad. It doesn't mean that even those funds are bad. Those funds have been good for those who invested early. And any fund, especially thematic funds, will be good only for those who invest early. Those who invest late almost always tend to get punished in thematic funds. The same is happening in small cap in every market cycle. We saw it in 2018, we are going to see it in 2026. Yet investors never learn. The unwillingness to buy a fund when its performance is not looking great almost always keeps investors out of the best performing funds of the future. Mostly investors buy only the best performing funds of the past, whereas only if they're able to invert this and buy funds when they're out of favor, when their performance is not looking rosy, will they be able to latch on to the best performing funds of the future. This is not happening. And this is not happening because there isn't enough of a contrarian bent in mutual fund investing. All stakeholders tend to be heavily biased by recency. As a result, it's very easy to form a consensus in the mutual fund space. In recent years, the consensus has been centered around small cap, mid cap, and flexi cap. Earlier, there was consensus on dynamic asset allocation. Every few years, this consensus view keeps changing. But almost inevitably, 1 year's consensus tends to fail the next year. So how do you buy a fund which will succeed in the next year? Buy what is completely out of favor and yet attractively valued in 1 year, and you probably will make good returns in the next year or the year after. It's only a matter of time before you make good returns in such an investment opportunity. But most people are not willing to even look at funds when they are out of favor, when consensus is completely against them. And that is why most investors who come into mutual funds have a mediocre investment experience. The products are all there around you. It's up to you to focus on the right products. It's up to you to invest in them rather than look at which fund did well in the last 1 year. There is no guarantee that the next year is going to be similar. If you realize this, I think your mutual fund investing can be taken to the next level, and you definitely will stop failing and start succeeding. After all, that's what we all want for every one of us. Thank you for watching this video.